Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Is 2024 going to be the year of the small cap? I think I've said that for the past couple of years, actually. My guest today specialises in global small caps and says investors should strap in and hold on this year. From cheap European stocks to the impact of the US election on markets, we've got a lot to cover. Remember, this is general information only and you should seek professional advice before making investment decisions. Vaughan Nelson has around $25 billion of funds under management and brought their global equities SMID strategy to the Australian retail and wholesale market a couple of years ago, where it's available as both a managed fund and an active ETF. Chris Wallis is the CEO and Chief Investment Officer of Vaughan Nelson, which is also a great supporter of this podcast. Chris is visiting Australia at the moment from Texas. We've grabbed him for a chat. Chris Wallis, welcome to Fear and Greed.
Thank you, Sean. So good to be here.
So just set the scene here. What's the outlook generally for small caps? And then I want to talk about some of the local small caps as well as overseas. But just broadly, what's the environment?
Yeah, look, the setup for small caps, and this is true across the globe, is there is not an area of the world that is not focused on either moving a supply chain, recapitalizing an industry, building infrastructure, accelerating an energy transition, and all of that underlying investment and all of the monetization of the deficits that comes with that is really supportive for economic growth. It doesn't mean it doesn't come without inflation. It doesn't mean that, every company gets to win. But what it does mean is the growth that is typically incredibly focused to small parts of the market when you're in a commodity downturn and on the downside of an investment cycle and everybody can crowd into their favorite large cap techs and make money. We're just in a very different environment. And we really began transitioning to this environment in late 2019. And then obviously COVID interrupted that, but it also delayed it. And with all the excess monetization and stimulus since COVID, it's only accentuated it. So it's as target-rich environment as I've seen. And I've been looking at small and mid-cap stocks for a quarter century now. So it's a pretty target-rich environment.
Okay, so what about valuations of small caps at the moment then, given what you've just said as the macro picture, but of course it all comes down to value?
It does come down to value. And like they say, price is what you pay and value is what you get. And one theme we have whether we're talking to our retail investors or institutional investors, is there is no theme, meaning there's not an area, there's not a region that is incredibly attractive from a valuation standpoint. So we need to really overweight this sector or this region. Valuations are incredibly attractive across the globe, across industries, but they're very company specific. And, for those that are a little bit more inclined to think through the math of what this implies, is if you kind of look at our global SMID strategy, it's got a return on assets of 9% plus, which is very attractive and quite high. It trades, which just means these companies are incredibly profitable. And then when you look at a forward multiple, it's about a mid-teens forward multiple, but the underlying earnings growth is about 12%. And if you kind of rolled those metrics through the more typical larger cap indices, my guess is you would find the valuations on a trailing and a forward multiple much higher, 20, 30% higher. So I think valuations are quite attractive. The multiples haven't pulled forward a lot of that future earnings growth. So as that earnings growth comes to fruition, you should get rewarded with the higher share prices. So I think valuations are incredibly reasonable. But again, it's not writ large. Like I can't make that comment about a broad index or a broad region, but the individual companies that really do have the reinvestment opportunities they're fine. They're very attractively valued.
Okay, so we have the macro environment, we have the valuation environment. My question is, how does Vaughan Nelson go about finding these small caps? Because the pool of small caps is literally in the tens or hundreds of thousands. What's your process about finding them?
Look, I think the most important thing in investing anywhere is what is the underlying return on invested capital for the business, which just means if they put $100 million back into the business, how much earnings do I get out of that? Am I going to get $4 million of earnings or $14 million of earnings or $24 million of earnings? And the higher that return is for the amount of capital reinvested, is the higher that the higher earnings growth rate, the faster intrinsic value is going to increase. So we have always focused on return on assets and return on invested capital. And so quite honestly, we have a database that looks at all of the companies within our market capitalization range by industry, by region in the world. And we look to see who is investing and are they being rewarded for that? And if they are, let's dig in and figure out how early are we in this reinvestment cycle and what is it going to look like? Conversely, maybe they're investing and they haven't been rewarded yet. And in that sense, you would have to assume, hey, either this management team is certifiably insane and they just like over-investing in a business, or hey, they're getting ready to give birth to a new product or a new geography or a new market. And so let's go in and look at that and let's talk to the management. Let's really look at the historical results. Let's look at what our own internal projections are. And let's decide if we really think the returns and the growth can justify the valuations. And we're pretty old school. We still just do discounted cash flows. And we still use a 12% discount rate because we like that as our own internal cost of capital. And we apply that yardstick around the world. And we find really little eclectic opportunities where these companies are going to be able to reinvest and grow. Regardless of what happens with interest rates going up or down, regardless of what happens with inflation reaccelerating or decelerating, we have to factor those elements in, but we don't want to make our investment thesis hinge on some macroeconomic factor coming to realization.
Stay with me, Chris. We'll be back in a minute. I'm speaking to Chris Wallis, CEO and Chief Investment Officer of Vaughan Nelson. Okay, so with all that in mind, I'm now actually sort of going to go more specific, though, the theme, there is no theme, kind of defeats the purpose a little bit here. But Europe, for example, you've made comments about opportunities in Europe. Why is that?
So, look, we always are going to go what we call sift through the ashes of where there's been a lot of volatility. And, with the first ground war we've had in Europe in a long, long time, and then some relatively difficult trade-offs they had to make from an energy standpoint, there was a lot of volatility. There's a lot of drawdown. There should be some pain and angst embedded in those securities. And what we have found is, to a large degree, a lot of those valuations, although they seem low or they seem attractive, they're kind of justified. A lot of those businesses are impaired, but not all of them. And what a consistent theme we have found is there's fabulous service companies. So, you can imagine we've stumbled across an Italian company that makes hearing aids. And, that doesn't jump out at you as a theme that's centered around industrial activity or anything like that. But it's an incredible manufacturer, right? And these companies that have new product innovations, they're rolling out into new geographies. And unfortunately, maybe their stock sold off or the valuation compressed because of things associated with the Russia-Ukraine war and people just selling out of their passive funds, and it kind of creates the valuations we need to hit our targeted returns. We're going to find unique situations like that. Also, there's regions of the world that are a little bit behind maybe where the U.S. is in moving digital infrastructure into the cloud. Some of those are in Europe. So we've been able to find IT services companies in France. Some of those are outside of Europe. We've been able to find similar situations in Japan as well. Everything is consistent with, hey, there's an underlying reinvestment theme. We have an inflection or stability in the return and the profitability of these businesses, but there's some reason that the valuation's been pressured, and it's usually unrelated to the underlying business. And Europe has just been ripe for that kind of volatility, given what we've known they've gone through for the last 2 years with the ground war in Ukraine.
Okay. Another thing I've seen you say, or write at least, or someone reported you, I think it was, anything but biotech.
Yeah.
Is that right?
It is. Anything but biotech. But Sean, I got to be honest, that reflects our own limitations. Look, we are not the guys that are going to figure out what molecule is going to be the next way to cure cancer. That's not what we do.
Yeah.
And it's okay. We do track investment trends. So I don't want to be just dismissive of biotech and med tech. Look, there is real capital that gets deployed there, and there's real innovation that occurs in those areas. While we may not invest in true biotechs, we will invest in and around that supply chain. So we're happy to invest in the companies that will run the medical trials. We're happy to invest in the companies that sell the instruments and the reagents and the testing equipment, or the companies that are going to ultimately market and distribute the drugs and the technology that comes out of that. We're just not going to risk the capital on the science. We're fairly simple. What we like to say is, if we can't value it, then we can't invest in it. And if you don't have a product, then I can't model you. I can't tell you what your addressable market's going to be. I can't understand what the profitability is going to be. And in that situation, I can't value it. And if I can't value it, I can't invest in it. I'd just be a speculator at that point. So by and large, we just do not invest in early stage biotech.
Okay, the final issue I just want to mention is the US election. In recent days, we've found out that it is on again, officially on again. We have President Biden versus President Trump. What's it mean for markets, but particularly around small caps? Because small caps don't always like volatility.
No, they don't like volatility. The interesting thing, unfortunately in North America, I think if you ask most Americans, we've got two poor choices to pick from. As it relates to economic policy, neither candidate is really going to make a significant difference. And what I mean by that is neither one is going to soften their approach on China, which obviously has a huge impact on the movements of supply chains and tariffs and underlying incremental inflationary pressure. So neither one is going to make any significant shifts there. The other big element is, look, we're way down the road on our sovereign debt crisis. And with that, it means our central bank's going to have to monetize deficits, and our economy can't grow without expanding deficits. And so we're going to run very loose fiscal policy, and whoever wins the election, that is in fact going to be the case. So that's not going to change. I think where it really matters, and I typically would tell you elections do not matter to the asset values, but it does in the US this time. And that's because some of the tax cuts that were enacted under Trump are going to set to expire in 25. And so the makeup of who's in the White House and the makeup of Congress is going to influence the negotiations around whether some of those tax cuts are extended or modifications are made. And inevitably, as I mentioned, we're going through our sovereign debt crisis. We're going to have a little bit of a hiccup in 25. And that's going to force probably one of the last political negotiations before we just acknowledge we're going to monetize our debt and deal with a little bit higher inflation in the US. And that trade-off could mean higher corporate tax rates. We'll tax a few wealthy. And the trade-off with that may be a little bit of a pullback in federal spending. So in that sense, look, it's going to matter, but it's really going to be just localized to the US. To the rest of the world, whether we let the crazy old man or the crazy orange guy, just isn't going to make a bit of difference.
Chris, what a way to finish it. Thank you very much for talking to Fear and Greed.
You bet. Thank you, Sean.
That was Chris Wallis, CEO and Chief Investment Officer of Vaughan Nelson, a great supporter of this podcast. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.